Hey out there, YouTube family. Welcome to another edition of the Kevin Strong Show. And in this video, we're going to talk about foreclosures. What's really going on in the market? And the title really should be Foreclosure Lies. So we're going to do a deep dive into an article that I pulled up that was written about a month ago that says one thing negative about the foreclosure situation in the country. And then they try to put a spin on it. So I'm going to try to debunk that, clear that up for you, and give you some insight based on my perspective. Once again, if you can do me the honor and great favor, hit that like button, comment, and share. You know what? Because I care. So the title of this article is Serious Mortgage Delinquencies Are Up 55% over pre-pandemic levels. But what this means for the housing market isn't what you might think. So this is the title of this article. I think it's kind of interesting because when they mention that 55 serious mortgage delinquencies are up 55% over pre-pandemic levels, that's a very, very interesting stat because that's removing the health crisis, right? Where everything was basically frozen. Lenders were not allowed to foreclose on homeowners who either weren't paying on their mortgage or facing imminent foreclosure default. So when you strip away 2000 and get a number like that, so for serious delinquency, basically what that means is that you have to be 90 days or more late on your mortgage payment. So if you haven't made a mortgage payment in 90 days, that's considered seriously delinquent. So typically what happens the first 30 days, you don't make a payment. You kind of get some notices from the bank or your lender or servicer. By that second payment, it's really starting to escalate at that point. You're going to get a lot of information either by phone calls or by way of mail, trying to reach out to you and open up the lines of communication. It's incumbent upon you to act, to open up that dialogue. I know it's a difficult situation. Once again, just for full disclosure, I've been in that situation back in 2005. And if you bury your head in the proverbial sand, you're going to lose your home. It's going to happen. So we're going to jump into this article. I'm going to give you my information and kind of share with you from my perspective what I think is going on with this. So let's not delay anymore. So it says, meanwhile, the overall national delinquency rate hit a record low. So remember the beginning of the article, it said, hey, prior to the pandemic, we had people who were 90 days late, which is considered seriously delinquent, 55% increase. Really, really, really bad. Because those folks, once again, are facing imminent foreclosure. But they say overall, the delinquency rate is low, which could be 30 days, 60 days. Those aren't considered 90-day late. So they don't go into the bucket of being considered seriously delinquent. But more than likely, that's the next step. Very seldom does somebody miss two payments and then all of a sudden get caught up, especially in this economic environment when we're dealing with so much inflation and other things that are just squeezing people's income and wages not keeping up with inflation. So the number of borrowers who are 3 or more payments behind went up 55%. We talked about that. Okay. While there were approximately 400,000 serious delinquencies remaining before the pandemic, today there are roughly 640,000, the data shows. Okay. So the company that's reporting this is called Black Knight, no pun intended. But however, just kidding. Hope you laugh. If you're laughing right now, take a pause for the cause and hit that like button. But anyway, Black Knight is a very well-respected kind of like research and statistical company that provides real estate data to the industry at large. So let's go back down here and look at some of this other stuff. Through serious delinquencies are up from a few years back. They were very low anyway before the pandemic. Before the pandemic data shows. And Black Knight reports they have fallen between 6 and 12% each of the past 14 months. So by reading this indicates on one hand that delinquencies are going down. But as I indicated at the beginning of this video, what stage of delinquency is the homeowner at? This article or this particular statement does not articulate Are we talking about 30-day late mortgages that have gone down? Are we talking about 60 days late? So it really doesn't give you insight as to what's going on. So I go a little bit further. Okay. Homeowners with FHA loans are more likely to be low to moderate income workers, and the pandemic had a greater impact on those homeowners as compared to those with conventional loans. Now, that is a true statement. FHA and VA are typically low down payment loans. The credit score to require for those type of loans are not as stringent as going with um, a conventional lender. So those people are probably a little bit more vulnerable during an economic pullback. I think that's a very accurate statement. I didn't give you the information about FHAs, but probably one of the leading delinquency mortgages in the United States by far is FHA. I don't have that number off the top of my head, but I would be comfortable in saying that the amount of FHA mortgages in the United States that are at least 30-day delinquent is probably somewhere between, I'm gonna say, around 7 or 8%. It's pretty high. I'm pretty comfortable in saying that. So I'm not going to read that. We're going to go down here a little bit um, further here. So it says the overall mortgage delinquency rate fell to a new record low. And not only that, foreclosure starts actually fell 12% from February to March, the largest month over month decline in 20 years, says Channel. Okay. And foreclosure starts are below pre-pandemic levels, which means that even if a relatively large amount of people are seriously delinquent, many aren't actively being foreclosed on. So what does that mean? That could mean that the lender has taken a proactive approach through their mitigation department to reach out to the homeowner and maybe work out a loan modification. Once again, that's something that we do at preventforeclosure.us. So that could have a lot to do with that. It's just this information is really perplexing because when you think about it, they're saying that it's relatively a large amount of people are seriously delinquent. Many aren't actively being foreclosed on. Well, like I said, are the lenders willing to work out with these people? Are they a little bit slow? Are the courts backlogged? Are people filing Chapter 13s, which is a motion to stay? I'm not a licensed attorney, but once again, I'm very well versed when it comes to Chapter 7 and Chapter 13 bankruptcies as it applies to a mortgage and creditors at large. So you can file a Chapter 13 bankruptcy in the 11th hour or at any point during your delinquency process, and that automatically stops the foreclosure. That does not mean you're not in financial trouble. But statistically speaking, if you are filing a Chapter 13, that stops foreclosure. So it takes you out of the seriously delinquent bucket because you're going to go through some rework program, payment program that's going to be administered by a bankruptcy attorney. And all of your creditors are going to basically have to get in line with that program. So once again, I think information like that needs to be included. But if you just read statements like that on the surface, it could lead one to believe that things are a little bit better than they actually are. So what does this all mean for the overall market? Okay, this is basically what they're saying. At the end of the day, despite a few hiccups here and there, most data indicate that the housing market is doing pretty well. The majority of people seem capable of keeping up with their mortgage payments, and this is what economists and real estate pros told Market Watch Picks about the housing market now. Okay, the majority of people seem capable of keeping up with their mortgage payments. Really? So let's talk about some things, because this kind of indicates that the overall economy is doing well. It is not. Okay. The fact, once again, that serious delinquency rate is up 55% pre-pandemic, which means those folks are more than likely going to go into foreclosure. That number is going to continue to increase. Now, the statement that we're analyzing now, the majority of people seem capable of keeping up with their mortgage payments. Let's talk about that. That kind of infers a couple of things. The economy's solid. The housing market's solid. I've said this, I can't remember how many times. I've said it on Facebook. Here is a simple way to look at all of this. You've got experts saying that we're going to have a recession. You got experts saying we're going to have a depression. You got experts saying we're going to have a severe housing crash, or the housing market's going to go down worse than it did in 2008. Nobody really knows exactly how bad or how good things are going to be as it relates to the housing market. But one thing I can tell you that to me makes a lot of sense, that kind of clears up all the noise. If you are in the camp that you strongly believe that housing is going to sustain or continue to grow, then you can't say on the other half of your mouth that we're going into a recession. I don't recall any time in history when we went into a recession and housing thrived. It doesn't work. It's almost like saying you have to be at two places at once, or jumbo shrimp. It's like what's the word I'm looking for here? An oxymoron, jumbo shrimp. It doesn't make any sense. You can't have a bleak economic outlook and then say housing's going to be okay. Housing represents about 62% of our gross domestic product, our GDP. It is the cornerstone, one of the major driving forces in our economy. So you can't say that our economy is going to suffer, but something that represents 62% of gross domestic product is going to continue to go up. It doesn't make any sense. Finally, some stats that also pierce this statement is that you've got student loan debt at 1.7, fastly approaching 2 trillion. People still have not made a student loan payment since what, March or April of 2020? The average student loan payment roughly is about $400. Really? And you think people are okay with paying their mortgages right now? I'm sure you guys are hearing the news about the auto industry, how that's imploding. Subprime loans and some A-listed creditors are also defaulting on their loans, on their car loans. The auto industry is in a lot of trouble. There was an article talking about 500,000 people that could not even pay their cell phone bills. Think about how the average person, present company included, how we lose our freaking mind if we can't find our cell phone. So if you're having problem paying cell phone, utility bills, putting food on the table, you can't pay for your car, which is almost like your lifeblood line to get to work so you can put food on the table. And if you can't make that payment, who in the hell really thinks when you add all of that up that it's not going to affect the housing market? Really? I can't pay my cell phone bill, okay? My car just got repoed. I haven't made my student loan payments in almost 2.5 years. Food prices are probably up 15, 20%. All right. And energy prices are probably up 30, 40% compared to last year. So you have all of these negative economic factors in a big pot. And then when you look in that pot, you say, oh, despite all that, hey, they're going to continue to be able to make their mortgage payment. When you can't make the aforementioned payments that I just mentioned, it's only a matter of time before it becomes blood in the streets as it relates to people being unable to make their mortgage payment. And also, the jobless claim that came out last week was the highest in 8 months. Layoffs are going to escalate at a rapid rate the latter half of this year, in my humble opinion. That also will exacerbate people's ability to be able to pay their mortgage. And even though they may have gotten a great rate at 3% last year, 30-year fix, your rate is a moot point if you lose your job and you don't have an emergency fund or any reserve funds to rely back on to continue to make your mortgage payment. So I think this whole article basically is a foreclosure lie. And that's why I titled this video as such. I hope you are enjoying this type of content. Once again, please do me the honor of like, comment, and share, because I know you care. This was the Kevin Strong Show, and I'll see you guys in the next video.